Happy Monday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. We have a big episode today. It looks like it is going to be a very busy week. Today's episode also contains this month's second sponsored feature. I'm especially excited about this one. We'll touch on that later in the episode. But for now, we need to begin in the Middle East. So let's jump in. Of course, the whole world is watching the unfolding conflict in the Middle East, now especially as the US has joined the conflict with its airstrikes on 3 Iranian nuclear facilities over the weekend, and China is no exception. Indeed, Beijing has plenty to be concerned about with the conflict and its escalation, while being quite powerless to shape it. In a brief but pointed statement, China's foreign ministry on Sunday strongly condemned the US strike, calling them a violation of international law and the UN Charter. The attacks, quote, exacerbate tensions in the Middle East, end quote, the ministry said, urging all parties, especially Israel, to cease hostilities immediately. At an emergency UN Security Council meeting the same day, China's ambassador, Fu Cong, criticized Washington's, quote, unilateral military actions, end quote, which he said dealt, quote, a heavy blow to the international nuclear non-proliferation regime, end quote. On Monday, today, China's state-run Global Times warned that Washington's deployment of bunker buster GBU-57 bombs risk pushing the conflict, quote, closer toward an uncontrollable state, end quote. Now, despite its strong rhetoric, China has shown little willingness to intervene beyond the diplomatic realm. It's no surprise that China is not very happy with this escalation. Xi Jinping, in a call last week with the Russian President Vladimir Putin, reiterated his call for restraint but stopped short of condemning Israel directly. Chinese officials have prioritized evacuating more than 1,800 nationals from Iran and several hundred from Israel as part of what analysts describe as Beijing's risk-averse approach. Some observers suggest that China sees the unfolding conflict as a double-edged sword. On the one hand, any prolonged US engagement in the Middle East could divert American attention and resources away from Asia, especially the Taiwan Strait. On the other hand, a regional war that disrupts global oil supplies through the Strait of Hormuz, where half of China's crude oil imports pass, could severely impact Beijing's energy security and economic recovery. This point is worth repeating. It is China who would be hit hardest outside the region if the Strait of Hormuz is closed. U.S. Secretary of State Marco Rubio on Sunday called on China to prevent Iran from closing the strait. Quote, I encourage the Chinese government in Beijing to call them about that because they are heavily dependent on the strait for their oil, end quote, Rubio said on Fox News. Rubio warned that any Iranian move to block the waterway would be seen as a declaration of war. An actual closure could send oil prices skyrocketing above $100 per barrel, even as high as $130 a barrel, according to some analysts, a development that would smash international markets and risk throwing the entire world into recession. Iran, the third largest oil producer in OPEC, exported nearly 1.84 million barrels per day in May, the vast majority to China. Analysts note that closing Hormuz would be an act of economic suicide for Iran, cutting off its own key revenue source. Still, even a temporary disruption could roil global markets for weeks. For now, China appears to be calculating its next move carefully. Its strategic partnership with Iran gives it leverage. Beijing has long avoided directly opposing the US in active military conflicts. Quote, the turmoil in the Middle East is both a challenge and a test for China, end quote, said Zhu Zhaoyi, a Middle East expert at the University of International Business and Economics in Beijing, adding, quote, it can't offer unconditional support to Iran, but it also cannot afford to lose influence in the region, end quote. Indeed, Beijing's growing regional ambitions, from brokering a 2023 détente between Iran and Saudi Arabia to expanding its Belt and Road footprint, depend on a stable Middle East. But recent events have exposed the limits of that strategy. Despite cultivating close ties with Gulf states and Iran, China has struggled to assert itself as a credible mediator when it matters most. As Xi Jinping and his foreign policy advisors weigh their options, at best, China risks looking impotent on the international stage, and at worst faces a massive double diplomatic and economic hit. As regular viewers know, critical minerals and commodity supply chains have been pulled into the ongoing US-China trade war, and the United States has accelerated efforts to bring critical supply chains back closer to home. This is something we have been following very closely for months now. The current US administration has signed several historic executive orders to protect copper production and mining on US soil. Copper demand is now surging, while supply struggles to keep pace with all this, while Washington is working to bring US copper production back home. Global mine production is expected to peak in 2026 with a projected 700,000 ton deficit in 2025 alone. Underinvestment in mines has created a supply crunch, and the US-China trade war has disrupted global copper supply chains. China controls 50% of global smelting. The world is hungry for copper, and this means big opportunities for savvy investors seeking to take advantage of this historic shift. And today's video sponsor, Giant Mining, provides such an opportunity. Giant Mining not only operates a silver, copper, gold project in Nevada, but also recorded its best ever drill intercepts in September of 2024. The company is the North American copper company to be watching. On the 14th of February, an executive order was issued that implicitly prioritizes copper as a critical resource. Nevada, where Giant Mining's copper project is situated, has consistently ranked among the top mining jurisdictions in the world. Giant Mining's balance sheet is now fully funded for its drilling programs in 2025. Giant Mining is well positioned to accelerate its exploration efforts and potentially capitalize on emerging copper market opportunities. The share price is down by 50% since February due to market turmoil, making it potentially a very cheap pick at the moment. Giant Mining owns the Majuba Hill copper project, a past producing mine. In the past 4 years, management and the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining hit their best ever drill hole. The 2025 results are now on screen. David Greenway, CEO of Giant Mining, commented on these that Nevada continues to prove itself as a world-class mining jurisdiction, ideally positioned to support the America First policy and bolster domestic resource security. With global copper demand soaring, Majuba Hill offers a compelling, homegrown solution to help meet America's significant and growing consumption of copper. Most excitingly, Greenway expressed the following on drill hole MHB34. In my entire career, I've never seen drill core like this. It's truly extraordinary. When we began drilling MHB34, we had high expectations, but what we encountered exceeded them all. In my entire career, I have never seen drill core like this. The presence of visible native copper beyond 1,850 feet is a powerful indicator of the scale and strength of the mineralized system at Majuba Hill. This hole reinforces our belief that Majuba Hill is evolving into a world-class copper, silver, and gold discovery. So, well below its all-time high, a mining-friendly administration, copper coming back to America, and a serious asset in Nevada. Like any mining company, this is a speculative play. High risk, but also a potential very high upside. As such, Giant Mining is worth doing your homework on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. Do your due diligence on Giant Mining. More information on this sponsored feature, including relevant disclosures, are in the description below. A big thank you to Giant Mining for sponsoring this episode of China Update. We now return to regular coverage. US tariff hikes on low-value packages from China are triggering a sharp contraction in bilateral e-commerce trade, disrupting key players like Shein and Temu. Chinese customs data released over the weekend show that small parcel exports to the United States fell to just over $1 billion in May, down 40% year-on-year, and the lowest level since early 2023. The slump coincides with the US government's decision to close the long-standing de minimis loophole, which previously allowed packages under $800 to enter duty-free. As of the 2nd of May, Chinese and Hong Kong origin parcels face tariffs of up to 54%, significantly rising costs for exporters. The policy shift is upending business models. Fast fashion leader Shein hiked US prices ahead of the new duties, while both Shein and Temu saw double-digit sales drop in the week after implementation. Smaller exporters have also been hit hard. Despite the drop, the US remains the top destination for Chinese small parcels. Malaysia followed with over $700 million in shipments. Globally, demand remains strong. Small parcel exports from China rose 40% year-on-year in May, with Belgium, South Korea, and Hungary among other growing markets. This suggests that these exporters in China have had big hits to their margins, but are instead moving their products away from the US to other jurisdictions. Meanwhile, China's other large market, the European Union, announced over the weekend that it will exclude Chinese companies from bidding on government contracts for medical devices worth over 5 million euros, $5.7 million US dollars, citing lack of reciprocal market access in China. The move escalates growing trade tensions between Brussels and Beijing and marks the first enforcement action under the EU's new International Procurement Instrument, IPI. Under the new rules, successful bids for affected public tenders cannot contain more than 50% Chinese medical devices. While some exemptions may be made in cases where there is no viable alternatives, the European Commission emphasized the policy is aimed at correcting persistent market imbalances. Quote, "Our aim with these measures is to level the playing field for EU businesses," end quote, said Trade Commissioner Šefčovič, adding, quote, "We remain committed to dialogue with China to resolve these issues." End quote. The Commission said its investigation found that 87% of Chinese public procurement in medical devices between 2015 and 2023 was closed to EU companies due to, quote, "exclusionary and discriminatory practices." End quote. Over the same period, Chinese exports of medical devices to the EU more than doubled. The EU's decision follows recent clashes over electric vehicle tariffs and retaliatory Chinese probes into European brandy. Brussels is signaling it will not tolerate what it views as asymmetric trade practices, particularly in sensitive sectors like healthcare and technology. While the Commission left the door open to suspending or withdrawing the measures if China addresses its concerns, Beijing has pushed back strongly. Chinese Foreign Ministry spokesperson Guo Jiakun condemned the EU's decision as protectionist. The move underscores Europe's broader shift toward economic defensiveness amid global tensions. As the EU seeks to assert greater trade reciprocity, relations with China are expected to face greater strain. This is just another nail in the coffin of the EU's trade relationship with China, which, after the US, is China's most important market. And finally for today, the Trump administration is weighing a controversial move to revoke long-standing waivers that allow top chip makers, Samsung Electronics, SK Hynix, and Taiwan Semiconductor Manufacturing, to supply their Chinese factories with US chip-making equipment without applying for licenses each time. The proposal was reportedly raised this week by Jeffrey Kessler, the Commerce Department official overseeing export controls, who framed it as part of the US push to curtail China's access to sensitive US technology. The proposed policy shift could significantly disrupt semiconductor supply chains and strain diplomatic ties with key allies. While the factories in question, like Samsung's memory chip facility in Xi'an, primarily produce legacy chips used in consumer electronics and cars, any operational slowdown could ripple through global markets. Though the US insists the move aims to align its systems with China's own licensing regime for critical minerals, like rare earths, which we've seen in recent weeks, industry insiders say it risks being interpreted by Beijing as a breach of the recent US-China trade truce reached in London. Commerce Department officials stress that chip makers will still be able to operate in China under a more controlled licensing system. Quote, "The new enforcement mechanisms mirror existing processes and ensure reciprocal treatment," end quote, a spokesperson said. Still, the policy could complicate US relations with South Korea and Taiwan, both close US partners and vital investors in America's chipmaking sector. Samsung, TSMC, and SK Hynix have notified their respective governments of the potential waiver revocation and are lobbying Washington to reconsider. In Washington, national security hawks argue that stronger restrictions are needed to hinder China's technological ambitions and drive global supply chain diversification. Though the outcome is undecided, the waiver issue adds fresh uncertainty to an already fragile semiconductor trade landscape and is yet another salvo in the ongoing US-China technology war. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for another episode tomorrow.